All right, hey everyone. Welcome to another episode of Trading Bitcoin. I'm your host, Tone Vays. Really wanted to start the stream 15 minutes ago, but it's the best I could do. I am out in an area called Santa Maria. There's an event here tonight. I got here a little bit early so I can bring you the stream. Gorgeous pool behind me. I should be just chilling in that pool with a nice, añejo tequila. But the Fed happens to completely interrupt our day, and therefore we're doing a stream. I am limited by battery life. I'm also limited by the sun, so it's very, very hard for me to see your comments. Let's go to the charts and see what happened. So here we are. Let me move this out of the way. I already see people talking about the FOMC drift and how it has not yet. The day is not over yet, first of all. And second of all, it doesn't work every time. If it worked every time, everyone would be a billionaire. So as I've said in my little video the other day, it works about 70 to 80% of the time. So this could easily be one of those 25, 30% of the time it didn't work. So let's go to the charts and see what happened the moment the Fed announced it. I also have pulled up the live stream. That's going to start in 15 minutes. So we'll try to catch some of this live as well and see what Jerome Powell has to say, because if he does 75 basis points again, I believe he's getting fired. But this time around, he was able to do it because the rate is still fairly low. And I think next time they'll raise it just 50 basis points. Let's go straight into the 10-minute chart. Gold going down. What about oil? Really curious. Oil also going down. Stock market. The stock market didn't like the 75% basis point rise in the rate, but everyone expected it to go up 75 basis points. So I am a little bit surprised that the market fell this much, considering that was the primary expectation. If we go to the Financial Summit Financial Summit. Oh, let me click on that. Financial Summit Twitter, we did send out, oh, this is their projections. Nice. So Jerome Powell did raise 75 basis points. Let's move that along. I do have people helping me with this Twitter handle, so it's great. Which escalating curiosity. This was an hour ago. Well, we know now. See, look at this. The majority of the people were actually expecting 100 basis points. Man, we should have sent out this poll a day earlier. That's our bad. The majority of the people expected 100%, 100 basis points, I mean. And we only got 75. So they didn't raise it as much as they thought they would. This is my video about the FOMC drift. But the expectation was the 75 basis points. Whereas scroll down a little bit more. Here we go. Right. So, oh, but that's still the end of February. Okay, there was another one of these for just this one particular one. Yeah, here we go. 300 to 325 versus 325 to 350. So there was an 84% chance it was going to go up 75 basis points, and only a 16% chance it was going to go up 100 basis points. I think the market is panicking a little bit unnecessarily. Here is Bitcoin. Bitcoin, of course, took a nosedive down to 18,700, and it is following the stock market. Let's go back to the stock market correlation. I think when Jerome Powell starts speaking, there is a high probability that the market will rise. Jerome Powell speaks in 10 minutes, and I will try to catch some of that speech. We could have a little fun with this. We can put Bitcoin on a 5-minute scale, and I can throw on a speculative bullish trade right now. Right here, right now. And on my bullish trades, I make them green. How many live viewers do we have? Moderators, I'm going to need you on this one because it's hard for me to see my screen. But I have my cell phone right here. And I'll have my cell phone open to my moderator Q&A group. So if there are any questions, we do have 500 live viewers right now. So let's see how it goes. Now, where's the stop loss going to be? Well, the stop loss is going to be below this candle. I do want to give it a little bit of leeway because when Powell starts speaking, there could be a little bit of volatility. But my real stop loss, which is in blue, my real stop loss is at the bottom of this candle. But I don't want to panic in case the market moves down for like 3 minutes. So I'm pushing the stop loss all the way down to give me some leeway versus the ultimate daily swing low. Okay. But if the price of Bitcoin goes above this orange moving average, I will immediately raise that stop loss to below this candle. And if the market goes, say, above 19,200, I'm going to move the stop loss into break-even position. But right now, I'm giving it wiggle room so that in 8 minutes, when Jerome Powell opens his mouth, all kinds of havoc is going to set in. And lots of exchanges may just go stop loss hunting. Okay. I'm also eyeing the stock market here. I should probably do it on this chart so I can see what's happening in the stock market. I may move this to a 5-minute chart and do it here. Let's do that. Let's do that instead. Let's move this to a 5-minute chart. Man, it's so nice out here. I don't know if you guys can hear the wind, but it's awesome. Yeah, Bernoulli, don't rub it in. It is 413 live. I'm saying 500 because I want to feel better about myself. But thank you for reminding me that it's only 413. 430 now. Okay. So 5-minute chart on here, and we have 5-minute chart on here. So I'm going to do the same thing. I'm going to throw on a bullish trade. Oh, well, that's more like the stop loss. So I'm going to put a stop loss down here somewhere. I'm going to make a green line and throw a bullish trade. I'm not going to cheat. I'm going to do it near the top of the candle, like on the other chart. We do have a take profit. My take profits are usually in purple. So I got to change color here. That's my take profit. My take profit is going to be way higher. Not that high. Well, let's see how it goes. Like, I'm going to put it high for now. And my bullish trades are in green. We will zoom in on Bitcoin. I will probably drop the MRI just for visual purposes, just so that the chart is nice and clean. And here we are. The stock market is rallying. Jerome Powell is going to open his mouth in 5 minutes. And let's see how he looks, how he sounds. Did he get any sleep? We will find out. Yeah, if there's any questions, shoot them over in the Telegram, Bernoulli. I see PM tag my name. Do you think there is a chance Bitcoin could hit new all-time high before the halving this cycle? Yeah, of course. Absolutely. I actually think that it will. I think that we will hit a new all-time high before the halving. I think the stock market overreacted. Everyone expected 75 basis points. It was priced in. The only thing I can say is as to why the market panicked like that is because it's possible that when the Fed announced the rate hike, they released a report. And you have these mega computers, you have these basically AIs, as they like to call them, that instantly will read that report. It only takes a fraction of a second for a powerful computer to read that report and analyze it to see if the Fed is really bullish or bearish. And now we can see the prices are rising as I expected, which is why I would prefer to be in a bullish trade right now than a bearish trade. Let's see how this trade works out for us, because the moment Powell opens his mouth, anything can happen. So I'm going to leave my stop loss down here somewhere. But as I said earlier, at 19.2, I'm raising the stop loss all the way up, at least to the bottom of these candles, but ideally 5 to 10 minutes into Jerome's speech. I'm limited by battery life. I'm going to plug in my portable battery here into my laptop, and hopefully that will keep us afloat. So you guys don't know, a few people know what my laptop looks like. It's an absolute beast. And unfortunately, because what an absolute beast this laptop is, my battery life is about 45 minutes. That's all I get on this laptop, is a 45-minute battery life. So I have a portable battery. You can see it in the little corner here. Oh. And this portable battery will extend my computer by maybe 30 to 45 extra minutes. You can see that the stock market drops a little bit right now with 3 minutes to go. Bitcoin is still hanging in there. But because the stock market just dropped, I'm expecting Bitcoin to drop. We could look at it minute by minute as well. You can put it on a 1-minute chart. And let's put the stock market on a 1-minute chart. And you could have timed, a nice scalp in Bitcoin with the stock market. You can see how this candle right here, so I lined them up, right? If you have a really good, let's line them up minute by minute, okay? Minute by minute. Super neat. So you can see how the Bitcoin had an amazing 1-minute candle that closed at the very top, but the stock market showed you a reversal candle. And then the stock market started to fall, and Bitcoin was still rising for a split second. So it looks like the stock market is very, very clearly driving the price of Bitcoin right now. And the stock market was ahead by about 45 seconds. So if you're fast enough, if you got, quick trigger fingers, you can tell how the Bitcoin candle is gonna end based on how the stock market candle is doing. It's not going to be an easy trade. There's no such thing as an easy trade. We got 60 seconds and counting. How am I going to do this? So I need to pull this out. I don't know how you guys are going to hear this. I can do this, and then I can do this. Nope, that's not the window. Where's the window? Is this the window? That is the window. So we're here. No, we're not there. Where's my window? We're here. Okay. So now I want to do this. How do I get rid of this thing? How do I get rid of this menu? This menu is super annoying. Okay. Let's turn on the audio. Oh, senhor?
Hola.
Era agua con gas y hielo y limón.
Ah, acá. Ya le voy a decir a un compañero que yo soy de acá.
Oh,
Pero
okay,
yo le voy a
gotcha.
decir.
All right. Now, how do I hear him? Oh, I hear him.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today,
Can I have confirmation that you hear
raised its
him and
policy
me?
interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing
reducing the size of the balance sheet may not go very well.
The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession.
That's bullshit.
Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace,
That's
in
true.
part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment,
That's true
while
too.
weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs.
Oh, look at the
and wage
market
growth
go. Look at it
elevated.
go. Look at it go.
Job gains have been robust, with
Raising the stop
employee
loss.
employment rising by an average of 378,000 jobs per month over the last 3 months.
Let's see if we
The
can go
labor
in the
market
green for the
continues
day.
to be out of balance,
I think
with
we will.
demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August.
Beautiful
but
sign
has
breaking the
little
prior
changed
swing
since the
high.
beginning of the year.
You could have added to your bullish position.
FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices.
Oh, he has to talk positively.
The median projection in the
That's his
SEP
job.
for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer run normal level. Inflation remains well above our 2% longer run goal.
I think they're going to
Over the
raise that
12 months
goal.
ending in July,
I think they're going to raise that
total
goal to like
PCE prices
3%.
rose
They're going to say how good it
6.3%.
is.
Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in core CPI was 6.3%. Price pressures remain evident across a broad range.
By the way,
of
he
goods and
sounds like
services.
he's in control, not like the
Although
last time
gasoline
he spoke.
prices have turned down, in
Looks like
recent
he got
months,
some
they
sleep
remain
too.
well above year earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation.
Stop blaming your cat shitting on the
The
carpet on
median
Russia.
projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters.
All right, so when
as
do
well
we
as
take
measures
profit,
from
guys?
financial
I'm raising the
markets.
stop loss all the way to here now.
That is not grounds for complacency. The longer the current
We're
bout of
way
high
above my
inflation
break-even area.
continues, the greater
I'm
the
setting a
chance that
break-even stop
expectations of
loss.
higher
That's it.
inflation
It's a
will
trade that
become
can't lose
entrenched.
money.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment
Shitty
and
reversal
stable
candle in
prices
the 1
for the
minute right there.
people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective.
Nice reversal right there on the 1
At
minute
today's meeting,
S&P.
the committee raised the target range for the federal funds rate by
Give me a new
0.75
high, and I'm
percentage point,
confident in this.
bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that
Don't
ongoing
think they're going to raise
increases
that 2%
in
target.
the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time.
New high, new swing
The
high.
historical record cautions strongly
That's great.
against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1
Gotcha.
percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision
Questions?
or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better
It sounds
alignment
very
with supply.
confident, guys. This is good.
Our overarching focus
Confidence
is
is
using
good.
our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations.
Why the
well
market is probably rallying.
Reducing
Sounds
inflation
very
is likely
confident.
to require a sustained period of below trend growth. And there will very likely be some softening of labor market conditions. Restoring
Look at
price stability
Bitcoin go.
is essential
Look at it go.
to set the stage for achieving maximum employment and stable prices.
We're
over
going
the
to take
longer
some
run.
profit here.
We will keep at it
Not
until
all
we're confident
profit.
the job is done.
I'm going to take some profit, half profit.
To conclude, we understand that our actions affect communities, families, and businesses across the country.
Half
Everything we
profit
do is
taken.
in service to our public mission.
That was
We at the
anyway,
Fed will do
whatever. I'm not
everything we can
canceled when I
to
said it.
achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right, good. You spoke confidently, took half profit. Now we're
Hi,
going to
Chair
raise the
Powell.
stop
Thank you for
loss.
taking our questions.
And
Judith
let's
Miles from
see
the New York Times.
How good the
I
questions
wonder
are.
if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
Good question. New York
So
Times. I didn't expect that.
I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The
That was like 3
FOMC
days
is
ago.
strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So On the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out, but not moving up. Payroll gains have moderated, but not much. And in light
I'm
of
gonna raise this stop loss.
high inflation we're seeing, we think we'll need to, and in light of what I just said, we
Let's
we
get
think
out of
that
this
we'll need
trade.
to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking
He's just
at? I guess, is
beating
your
around the
question.
bush.
So we'll be looking at a
Answer
few
the damn
things.
questions.
First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2%
Stop loss didn't get
before
hit.
we would consider that.
Beautiful.
Thank you, Mr. Chairman. Steve Leisman, CNBC.
Yeah,
Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates? Or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
All right, good question. I like it.
Sure. So,
Hey,
Of
we're
course,
back
monetary
to full
policy
position.
does
I'm going back
famously
in.
work with long and variable lags.
Back to where we
The
were
way I
before.
think of it
I
is
like
our
this. I
policy
like this.
decisions
We're
affect
back to
financial
100%
conditions
long at the
immediately.
same
In
price
fact,
we
financial
exited.
conditions have usually
So it's
been
like we
affected
never
well
exited.
before we actually announce our decisions. Then changes in financial conditions
I
begin
like
to
this
affect
breakout.
economic
I like
activity fairly
the
quickly
breakout on
within
the
a few
S&P
months.
too.
But it's likely to
Boom,
take
we're about to
some
be in the
time,
green, guys.
to see the full effects
Don't
of changing financial conditions on inflation. So we are very much mindful for that. And
What's
that's
this
why I
blue
noted
line?
in my opening remarks that at some point as the stance of policy tightens
I don't know
further,
what that blue
it will
line
become
is.
appropriate to slow the pace of rate
But,
hikes while we assess how our
we're
cumulative
close
policy
to
adjustments
being
are
green
affecting
for the day.
economy and inflation.
I think we're gonna go green today,
So that's
guys.
how we think about that. Your second question, sorry, was
Is there a point in time you can see pausing? Is it linear and you keep raising rates, or is there? Oh, sorry. I should know better than that. Top of my microphone.
I should know better than to answer your second question.
Well, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out
Yeah, that's the good question.
what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I
Boom, we're
mentioned,
green for the day.
what we think we need to do and should do is to move our policy
There we
rate to
go.
a restrictive level that's restrictive enough
There we go.
to bring
There's
inflation
a
down to
breakout.
2%, where we have confidence.
That's why
in
we're
that.
back
And
in the long
what you
trade.
see in the SEP numbers is
Bitcoin
people's
ain't green
views
for the
as
day,
of,
but S&P
as of
is.
today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time. And I think we'll
Let's get out of the 1 minute.
we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today we're just
Where the market open
we've
today?
just moved, I think, probably into the very lowest level of what
That's
might
market
be
open
restrictive.
right there.
And
We're
certainly in my view and the view of
way
the
above
committee,
the
there's a ways to go.
Beautiful.
Chair Powell, Rachel Siegel from Washington Post. Thank you for taking our questions.
All right, the most
The
communist
projections
paper in
show the
America. Let's
unemployment
go.
rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Okay,
Right.
she should not have been allowed in that
the-
room. That's
in
a
the
stupid
SEP,
question.
there's
I'm not
what I would
surprised it came from
characterize
the
as a
Washington Post.
relatively modest increase in the unemployment rate from a historical perspective, given the expected
The reason is because the
inflation
percentage
why
rate has
it's not.
nothing to do with
So
recession.
really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways. And I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible.
Boom. So
I'll
since
say,
our
that job
entry,
openings could come down significantly,
we're
and
up.
they need to. Without as
Bitcoin
much
is
of an
up
increase
3.5%.
in unemployment as has happened
this
in earlier
been
historical
what our
episodes.
trading
So that's one
contest, I would have done
In
this
addition,
at
in this
20x.
cycle, longer run
And,
inflation expectations
Would have been a
generally
nice
been
trade.
fairly well anchored. As I've said, there's no basis
The
for
trading
complacency there,
contest
but
we do at the
to
financial
the extent
summit has
that,
a maximum of
continues
20x
to be the
leverage.
case, that should
for
make it
6
easier to
hours.
restore price stability. And I guess the third thing I would point to that's different this
We're moving
time
to
is
10-minute
that
candles.
part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy.
Oh, great. He
and more
figured out it was the
recently
supply issue.
amplified and added to by Russia's invasion of Ukraine,
Nope,
have all
stop blaming
contributed
Russia.
to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles.
Russia invading Ukraine
And
didn't do
in
anything. It was the
principle, if those
sanctions
things,
that the
start to
idiots
get
put on
better, we
Russia
do see
that caused
some
it.
evidence of the beginnings of that. It's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say how much these factors will turn out to really matter in this sequence of events. It remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment,
Let's see if Bitcoin can make
and
a
soft
new swing
landing
high.
would be very challenging.
It would have
We
to.
don't know. No one knows whether this process
Where
will
would it
lead to a
have to go?
recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price
That would be a new high.
inflation pressures
for the
come
day.
down, whether expectations remain anchored.
I think you
and
can do
whether,
it.
Also, do we get more labor?
Guys, I'm
supply,
raising the
which would help
stop
as well.
loss.
In addition, the chances of a soft landing are likely to diminish to the extent
Right below
that policy needs
19.5.
to be more restrictive. Or restrictive
Purple
for
is my
longer.
new take profit.
Nonetheless,
We got back
we're
into that
committed to
trade
getting
for full.
inflation back down to 2% because we think
I'm
that
gonna put it at a new
failure to
high.
restore price stability would mean far greater pain later on.
Yeah, this might be it. It might have topped out.
Labor market and how much room there is there.
Yes, the vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding what the labor market is.
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
That's an unreasonably
Well, so-
convoluted question.
Again, we
Jesus, Wall
we
Street
believe
Journal,
that we
get-
need
like,
to-
just ask a simple question.
raise our policy
do it.
stance overall to a level that is restrictive. And by that, I mean, is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know, you look at where rates are real.
Yeah,
and
we're done.
nominal
We're
in
done
some
with the trade.
cases. You look at credit spreads. You
I
look
think
at,
it's over.
at financial conditions indexes. We also, I would
We
think,
did
and you
reach a
see
new high
this
at one
in
point.
this is something we talked about today.
We
in
didn't
the
hit the
meeting
stop loss yet.
and talk about it in all of our meetings. And you
We didn't
see
hit
this,
it
I
yet.
think, in
We
the
didn't hit
committee
it yet.
forecast. You want to be at a place where real rates are positive
Let me see
across
if
the
we hit it.
entire yield curve. And I think that would be the case if you look at the
We didn't hit
numbers
it.
that
We
we're
did
writing
not hit it.
down and think about you measure those
Right
against
below that
some
swing
sort
low.
of
We didn't
forward-looking
hit it yet.
assessment of inflation.
Maybe we'll
Inflation
get lucky.
expectations. I think you would see at that time, you'd see positive real rates across which across the yield curve, and that is also an important consideration.
Oh, there it goes. There it goes. Boom, done. Trade over.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on that, on this.
Is it over?
You're saying it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month?
Saved it by a
baseline?
penny. Look at that.
So we make
Look at that.
one decision per meeting, and the meeting decision we made today was to raise the federal
See what
funds rate
happens.
by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But
that's
there's
not
also
gonna
there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
Just
I gotta listen to a
follow-up,
voice
I'm wondering about the
message.
Sort of risk management considerations here, given there's some discussion now of overdrilling. What's the incentive front loading right now?
Oh, crap.
Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still strong?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to, and we're still discovering what that level is. But people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking.
I'm sorry, I didn't hear his answer. I was listening to a voice message.
Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is going to tolerate?
Oh, so the question isn't very useful, but
2.1 in
didn't I just say that?
2025, and
Didn't I just say they're going to target a higher inflation
headline
point?
is at 2.0, so that's pretty close. I mean, we write down our forecasts and we figure out what the median is.
But they have no clue what's going
So
to happen in 24 and
it's not,
25. So I
I mean,
don't even know. I
would say
hate
that
those dot
you know,
plots. They're ridiculous.
If the economy followed this path, this would be a pretty good outcome. But you're right, it is a 10th higher than 2%.
Just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we as we said, at the last
No, because
press
he'll get
conference and in
fired if he
between
keeps raising
that
the
one
rate
and
by
this
100
one, we
basis
said that
points. Don't
we would
replace it
make
with
our
someone
decision
who
based
won't.
on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly. And I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come. It is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision. And I don't expect that we will anytime soon.
Thanks. Neil Irwin, Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with fellow central bankers? And is there much risk of overdoing it on a global level?
That's a decent question.
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact.
Don't they have a mandate to help fight global warming? Why are they flying around on private jets back and forth to Switzerland?
Price stability, but we regularly discuss what we're seeing in terms of our own economy and international spillovers, and it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us, and vice versa. The forecast that we put together, that our staff puts together, and that we put together on our own, always take all of that, try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about, the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it. It's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times. But really, we're in very different situations. But I will tell you, our contact is more or less ongoing. And it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future, and indeed Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that might be a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very, but there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening.
It's like the guys aren't happy that the economy is able to handle this.
Declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. It's just, and we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's a good reason to think that this will continue to be a reasonably strong economy. Now, the data
I like
sort
a
of
statement. There are some
showing
people
that
out there with
growth
some
is
savings
is
that we
gonna be
have
below
not yet
trend this year.
inflated
We think
away.
the trend is being about 1.8%.
But they're
in
working
that
on
range.
it.
We were forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that. And that's a good thing because that means the
Jesus
economy
Christ,
will
they're
be more
still wearing
resistant
masks.
to
Oh my
a significant downturn. But of course, we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below trend growth and
This should be
modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward looking and the lags in your policy are forward looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
You won't.
So I don't know what the odds are. I think that
You can't go
there's a
too
very
far.
high
The US debt will implode.
that will have a period of what I've mentioned is below trend growth, by which I mean much lower growth. And we're seeing that now. So the median forecast, I think this year for among my colleagues and me was 0.2% growth. So that's very slow growth. And then below trend next year, I think the median was 1.2, also well below. So that's a slower, that's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have. And we
All right, let's get back to the trade. So basically,
well,
we may
never
or
say
may not
there are
have
too
gotten
many
stopped
people
out
working.
over here.
But the real point
So
is this.
if you got stopped out,
inflation, what we hear from people
you're
in
done for the
neighborhood
day or go to
is
the gym.
that they
You did not
really
get
are
stopped
suffering from
out.
inflation. And
I
we wanna
would
set
wait till
ourselves
we
up
break the swing high
right the way to another
and
period
then raise the
of
stop loss to
very strong
there.
labor market.
I would
Got to
also
inflation
strongly
practices.
consider
I wish there
going
were a
long,
painless way to do that. There isn't.
above this
So
swing
what we
high.
need to do is get rates up to the point where we're putting meaningful
So
downward pressure
assuming we're not in the
on inflation.
trade,
And that's what we're
there is
doing.
a new trade.
And we certainly don't hope, we certainly haven't given up the idea that we can have a relatively modest increase in unemployment.
This was
Nonetheless,
the
we need
initial
to
entry, by
complete
the way.
this task.
How will you know, or will you know?
It's hard to hypothetically deal with that question. I mean, our
So a new
really
trade
tight focus now
shows
continues
up
to
at the
be
break of the price.
ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability. And you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that inflation, high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that will work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation.
Yep.
So if your family is one where you spend most of your paycheck,
So you'll need a
every
second
paycheck
job,
cycle
and therefore
on gas, food,
number of
transportation,
employment
clothing,
goes
basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't.
There is. You
We
can
have
just
to
get rid of
supply and demand
sanctions
back
and start buying
into
cheaper energy.
alignment. And the way we do that is by slowing the economy.
But that's
Hopefully, we
not,
do
he
that by
can't do
slowing
that.
the
That's the
economy.
fiscal
And
stupidity
we
by
see
the
some
politicians.
softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back,
I would
from the
actually
task
be
of doing that
bullish
is
now
you're just-
at a
you're
lower
just
price
postponing.
because we hit a
The
lower
record shows that if you
price.
postpone that, the delay is only likely to lead to more pain. So, I think we're moving to do what we need to do and do our jobs. And
I think this should end
that's what
soon.
you see
I don't
is
think he's
going.
going to be talking for like 3 hours. He's not from Vays.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
Well, that's a
How
silly
long?
question. He has no idea.
It really depends on how long it takes for wages and more than that, prices to come down for
Ask him a
inflation
real
to come down.
question.
And what you see in our projections today.
Ask him a real question, like at which point is that interest rate going to start to implode the US's ability to borrow money that they print? Because the US basically printing money and it borrows it from itself, paying the interest. So he can't raise rates too much or it's just going to implode. Or ask him a question about the US dollar rising against, the shitty Western currencies. Or ask him a question, what does he think about the BRICS? And what if the dollar, goes against the BRICS? Will it continue to rise? Like, ask him some real questions.
Control. And that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year expansions. And you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps.
By the way, if we make one
we've
more
seen
low
in-
without
in-
touching
since
the
we
blue
started
line,
keeping track of that. So
the bullish
we want to get
entry
back to
again
that, but
goes
to
down.
get there, we're going to have to get supply and demand back in alignment, and that's
we're
going to
making
take
one more
tight.
low. I like
tight
this
monetary
consolidation
policy for a period of time.
What is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve.
California
But they're
running
not
out
as
of
painful
electricity.
as failing to restore price stability, and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises. And so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Oh, CNN, this should be good.
Nicole Goodkind, CNN Business. Existing home sales have fallen for mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of,
well, if we weren't out of the
red
trade
hot
before,
housing
we're out of the
market
trade
all
now.
over the country where famously houses were selling to the first buyer at 10% above the ask before even seeing house, that kind of thing.
Shit, there goes my battery. All right.
There was a big
how
imbalance
enough?
between supply and demand. Housing prices were going up at an unsustainable.
All right, I just got a 10% warning. My battery's gonna die in 5 minutes. I had a full battery when we started this show. I even have a plugged in battery. You know what I can do? I can save some battery by turning off my second monitor. I disabled my second monitor. So that should save me a little bit of battery life. Let me try not to dox my private chats. And now I can, well, let me see if I can change the screen share. No, I still have to share my whole monitor. That's okay. So there goes the price. Oh, why am I still holding this thing? Okay, so I can open your live chat. But my computer is still going to die in a second. There, I could do this as well. So my computer dies in a sense. So did anybody find it strange that like the really, it's just, God, I hope no one takes this out of context, but out of all the questions, right, the most socialist, most like left-leaning publications had female reporters, and the less left-leaning publications had male reporters. I just found that a little bit interesting. Like the moment I heard CNN, I expected it to be a female reporter. The moment I heard Washington Post, I expected it to be a female reporter. New York Times, I'm not sure. I'm not sure if that was a female or a male, but now we know how left-leaning CNN is. We know how left-leaning Washington Post is. Bloomberg, on the other hand, is not that crazy. Bloomberg is fairly down the middle, and it's just interesting, right? Like the moment I heard CNN, I just knew it would be a female reporter. Like I don't know if they even have male reporters, but yeah, I just find it. I always find that correlation super interesting. All right, let's look at your live chat. I like that candle right there. Maybe one more shot at a bullish trade. How about that now? And with the stop loss, very, very tight, right below that swing candle's low. And the goal is to get a break-even trade as soon as possible. So the moment we break the high of this candle, this becomes a break-even trade. No reason to lose more money. Or, well, we didn't lose money today. But no reason to lose money. I hope I'm still live. All right, I'm gonna check your moderators. If you need to message me, use Telegram. But I can open your live chat here.